This is a podcast from the Business Times.
Welcome to the BT Mark-to-Market podcast. My name is Ben Paul, and I'm a senior correspondent at the Business Times. This series of podcasts, which is based on my weekly column in the Business Times, aims to provide analysis and insight on market trends and corporate issues in Singapore. We're in the month of May 2024, which means the peak season for annual general meetings, which tends to fall in the latter half of April, has just come to an end. AGMs are, of course, an important forum for investors to engage with the boards and management of public listed companies and vote on key matters. So it's perhaps quite fitting that on the 23rd of April, during the crush of AGMs, Singapore Exchange Regulation proposed changes to its listing rules in order to better facilitate the requisitioning of shareholder meetings by minority investors. The proposed rule changes are currently going through a month-long public consultation exercise, which ends on the 23rd of May. With me in the Business Times podcast studio today to talk about why the proposed rule changes are necessary is Tan Boon Gin, the Chief Executive of Singapore Exchange Regulation.
Hi Ben, happy to be here.
Boon Gin, before getting into the rule changes and why SGX RegCo has proposed them, I think it'd be a good idea to first talk about the larger question of regulation and the rather weak long-term performance of the Singapore market. There's an often repeated view that investors somehow lack confidence in the Singapore market, even though there are a lot of stocks that appear to be trading at attractive prices. For instance, we have many property stocks trading at big discounts to book value. There's a general sense that nothing is going to be done to improve the market valuation of those stocks. Do you agree that there's a sense of apathy in the market? And is there a role for a market regulator such as yourself to make things better?
You know, Ben, the exchange is like a platform, and our companies are like our products. For the market to thrive, both must do well. The exchange must do well, and the companies must also do well. Everybody has a role to play, including us as regulators. As you have pointed out, the concern today is about valuation. So we have chosen to focus on the creation of shareholder value, or a value-focused approach. Now, value focus starts with the board. Whether it's through paying of dividends, conducting share buybacks, or doing a strategic review to decide whether they should be investing more through mergers and acquisitions, or divesting non-core assets to focus on priorities. If the board doesn't do this, market discipline should kick in to push the board to do these focused value activities, by which I mean that shareholders and investors should push the board to do these value-focused activities. So, as regulators, we want to enhance the effectiveness of the board because value focus starts with the board. And if necessary, we want to encourage market discipline to push the board to do value-focused activities. And finally, we want to remove any market friction that gets in the way of value-focused activities.
So, in practical terms, how do you do that?
We have introduced a 9-year limit on the tenure of independent directors. And we're doing this to enhance board independence and board renewal. This is important because we believe that new directors will have new ideas and be less wedded to current management and to the legacy business. We have new rules requiring board diversity disclosures to promote board diversity because we believe that greater diversity will improve decision-making and openness to opportunities in new areas such as sustainability. We are also trying to increase the transparency of the link between pay and value creation by enhancing the remuneration disclosures of the board and CEO. Now, turning to market discipline, encouraging market discipline is another major area of work in the value-focused approach. If shareholders and investors have a stronger say, companies will have greater incentives to consider their interests, improve operational performance, and shareholder returns. And that's why we are currently consulting the market on the convening of shareholder meetings. We think enabling such meetings will drive change. We also intend to work with our industry partners. The Securities Investors Association of Singapore, or SIAS, has recently indicated that they are studying the possibility of posing additional questions to boards of undervalued companies on their plans to improve valuations. We support this and encourage companies to respond meaningfully and comprehensively to such questions. Finally, we are also looking at ways to reduce market friction. We have heard market feedback on how our trading queries may affect the ability of companies to conduct value-focused activities such as share buybacks. We are thus reviewing the queries that we pose to listed companies to see whether we can issue them in a way that creates less noise for the market while still ensuring that material information is available to investors. Now, this is in addition to our existing efforts to be more targeted in our queries. So this has already led to a fall in the number of queries issued in the last half year. So taken together, all these we believe will drive value-focused behavior.
So let's move on to the proposed rule changes to better enable minority investors to requisition shareholder meetings. All public listed companies are required to hold an annual general meeting, but the rule changes SGX RegCo has proposed relate to extraordinary general meetings to vote on specific matters. From what you've just said, Boon Gin, the proposed rules fall into the market discipline bucket of your value-focused approach because they would empower minority investors to push for change. And let's face it, when minority investors invoke their right to requisition an EGM, it's usually because they're unhappy about something the incumbent board and management have done or have not done. What are the obstacles that minority investors face when they attempt to requisition EGMs, and how do the proposed rules help them?
You're right in saying that when shareholders requisition meetings, it is usually when they do not see eye to eye with the board and management. So the requisitioners may not be able to count on the company's cooperation. In practice, the requisitioners either face some technical difficulties in convening the meeting, or the company raises some technical objections to say that the meeting is invalid. One example is when the requisitioners need to give notice to all shareholders by sending the notice personally to the shareholders' registered address, because this is required by the company's constitution. To comply, the requisitioners may need access to the shareholders' personal particulars. If the company does not cooperate, the requisitioners may find it difficult to get this information.
Okay, you're referring to the fact that a lot of investors hold their shares through the Central Depository, or CDP, and this was a surprise to me as well, that while listed companies are able to obtain the particulars of depositors from CDP, the Personal Data Protection Act prevents CDP from providing the same information to requisitioners. So requisitioners of EGMs generally need the cooperation of the company's board to reach out to their fellow shareholders. But what are the other obstacles that they might face?
Another challenge is that the official channel for a company's communication to the market is through SGX Net, which is the platform hosted by SGX. And the company holds the key in terms of access to SGX Net. So requisitioners may not be able to post announcements, circulars, and forms on SGX Net without the cooperation of the company. What we are proposing is that companies must facilitate the convening and the conduct of meetings as soon as practicable within 21 days of the requisition notice being given. And some areas in which we want to see the company help facilitate the meeting is by releasing announcements and documents such as notices, circulars, and proxy forms on SGX Net, sending these documents to shareholders, and collating any proxy forms submitted by shareholders at the issuer's registered office. This will help overcome some of the technical difficulties that requisitioners face. I also mentioned that we have seen companies raise technical objections to dispute the validity of the meeting. What we want to see in this regard is if the company wants to dispute the validity of the meeting, the company should first engage with the requisitioners to try and resolve the issue. Ideally, any technical issues should be solved here. If both sides are unable to come to an agreement because, for example, there is some fundamental disagreement about whether the resolutions to be tabled are legal or illegal, then the company should apply to court for a ruling on the matter. So this change also aims to make clear to boards of companies the process by which they should handle shareholder requisitions. At the end of the day, what we want is for the meeting to take place as soon as possible so that shareholders can express their views, vote, and the company can move on. Otherwise, we end up with a protracted delay that is in nobody's interest because it results in uncertainty in the affairs of the company and creates confusion for shareholders, and also distracts the board and management from the business of the company.
Okay, so what exactly are the rule changes that have been proposed?
In our public consultation, which opened on 23rd April and which will close on 23rd May, we are asking the market two questions. Whether, first, when a company has received a notice to requisition a meeting that meets all the legal requirements, the company should provide the assistance that is reasonably necessary to the requisitioning shareholders to convene the meeting. And second, if the company wants to dispute the validity or legality of the requisition notice, the company must go to court to apply for a ruling. So, Ben, if you want to provide feedback to us, you can do so via SGX RegCo's website up until 23rd May.
Still to come, lessons from recent shareholder meetings at Great Eastern and Sabana Reit.
Catch up on the biggest headlines and developing stories every weekday morning at 10 a.m. with Lens on Daily. From the Business Times team that brings you Lens on Singapore, a monthly look at socioeconomic and societal issues impacting our lives here in Singapore and in the wider region. Go to bt.sg to listen or download.
And now, back to Market from the Business Times with Ben Paul.
We're talking to SGX RegCo CEO Tan Boon Gin. Boon Gin, the rule changes that SGX RegCo has proposed to better facilitate the requisition of EGMs by minority investors did not come out of the blue. In April last year, you put out a regulators column that outlined how requisitionists and boards ought to conduct themselves under these circumstances. And that column came after a spate of EGM requisitions involving companies such as Kitchen Culture, MeTech International, EcoWise, USP Group, and Allied Technologies, among others. Requisitioning an EGM is not the only way that minority investors can push for change. Minority investors can also put forward resolutions at a company's EGM. Under Section 183 of the Companies Act, shareholders can propose resolutions at AGMs if they hold at least 5% of the company's shares or comprise not fewer than 100 shareholders in possession of shares on which there is an average paid-up sum per shareholder of at least $500. This is a lower shareholding threshold than for requisitioning EGMs under Sections 176 and 177 of the Companies Act, which require requisitionists to hold at least 10% of the company's shares. So you could say that shareholder requisition resolutions at an AGM are a poor man's EGM. Sort of. Back in episode 41 of this podcast series, I spoke to a former remisier by the name of Ong Chin Woo, who tried to put forward 3 resolutions at Great Eastern's AGM to address the steep undervaluation of its shares in the market. But Great Eastern flatly rejected the request on the grounds that it did not satisfy all the necessary requirements without actually explaining what the requirements were. The Securities Investors Association of Singapore criticized Great Eastern's rejection of the proposed resolution, saying that it was somewhat legalistic and appears to sidestep substantive concerns raised. Boon Gin, can I ask why SGX RegCo is not also changing the rules for minority investors requisitioning resolutions at AGMs and requiring that companies either accept the resolutions or take the matter to court?
If we go back in time, right, what prompted us to propose these changes was a wave of shareholder activism, and they were using their rights under Sections 176 and 177 of the Companies Act to convene an EGM to table resolutions rather than their right to table a resolution at the AGM under Section 183, which is what we saw in the Great Eastern case. So Section 183 is something that we are just beginning to see compared to Sections 176 and 177. Now, both are ways for shareholders to exercise market discipline, which we want to encourage. So if there's any feedback that we should extend the same approach for tabling resolutions at EGMs also to tabling resolutions at AGMs, we will certainly consider. There are differences though that I should highlight. Under Section 183, if the company declines to table the resolution at AGM, the shareholders can attend the AGM to ask why, and the board will have to explain and account to the shareholder. That was what happened at Great Eastern. The board had to address the shareholders' concerns. The second difference is that, unlike an EGM, the AGM has many other necessary matters that need to be voted on by shareholders. The AGM also needs to take place by a certain fixed time. So it may not be as practical to require companies to go to court to get a ruling because of the time constraints and impact on other shareholders.
But would SGX RegCo expect companies in practice to treat requisitions for resolutions at AGMs in the same manner as requisitions for EGMs?
Well, these are all legal rights under the Companies Act. So if the legal requirements are met, we certainly expect companies to put through the resolutions requisitioned by shareholders, whether at AGM or EGM.
So the proposed rules in relation to the requisition of EGMs is really to codify behavior SGX RegCo expects of companies anyway.
Yes, if in fact you go back to our regulators column, which we issued as early as April 2023, when we started to see this trend of shareholder requisition meetings, we had already set out our expectations for companies to enable these meetings to take place. And this ties in with our focus on shareholder value creation because this is a form of market discipline being exercised by shareholders. And this is something we want to encourage to drive value-focused activity.
Another interesting case that keeps making headlines is Sabana Industrial REIT. Last year, activist unit holders of Sabana requisitioned an EGM to put forward resolutions to internalize its management function. Those resolutions were passed, but the path to internalizing the manager has proven to be rather complicated, and the activist unit holders have been trying to direct its trustee on how to handle the internalization plan by putting forward further resolutions at EGMs. The trustee said earlier this year that some of the additional resolutions and EGMs were not beneficial to the progress of internalizing the management function of the REIT. Do you have a comment on this particular case? Is there such a thing as having too many EGMs?
I need to be careful here because there are ongoing legal proceedings, so nothing I say is specific to the case.
Okay.
But to answer your question generally, the whole reason why we are trying to introduce these changes to our rules to enable shareholder meetings is to prevent such meetings from being drawn out and protracted. So yes, there can be too many EGMs. It can be costly, it can be confusing, it can be distracting. At a certain point, a court could very well say that there must be a finality to the issue, and any further attempt to retry the issue again and again through further EGMs is frivolous and vexatious.
Can I ask how you see this particular trend playing out? The sticking point seems to be that internalization of a REIT's manager requires an amendment to its trust deed, which requires an extraordinary resolution with a 75% approval threshold, unless it can be certified that the amendment does not materially prejudice the interests of investors. Is there room, in your view, for regulators to weigh in on the internalization of REIT managers, or is it something that ultimately has to be decided by the courts?
Again, speaking generally, we are supportive of the concept of internalization as an option for unit holders because it allows unit holders to express their views and hold the external manager accountable. And it is a form of market discipline to push external managers to deliver value for unit holders. In fact, the reason why the external manager model has worked well in Singapore is because unit holders can see the value of an external manager owned by a strong sponsor that can provide a pipeline of assets to grow the REIT or to help the REIT secure better financing terms. In terms of the process, I think there are some lessons for us. Ideally, it should be a one-step process so that all the necessary resolutions are voted on at one go rather than a multi-step process. It is also better for unit holders to have a visibility of everything end-to-end so unit holders know what questions to ask and can test the validity of the arguments made by both sides.
Earlier in this podcast, you said that SGX RegCo is taking a value-focused approach, which I think would be very heartening for many investors. When the topic of weak stock prices is brought up, one response we often hear from companies is that they cannot control the market. In effect, they put the blame for the undervaluation of their shares on investors. But investors do recognize enhancement of shareholder value when they see it. For instance, stocks like Keppel and Sembcorp Industries have performed very well over the last couple of years, partly because of big value unlocking initiatives. Is there room for more prescriptive forms of market regulation in Singapore to push companies to unlock value? For instance, the Tokyo Stock Exchange made headlines last year when it began requiring companies trading below book value to come up with policies and specific initiatives for improvement. Since then, South Korea has also asked its listed companies to disclose valuation enhancement plans. Should Singapore follow the example of Japan and South Korea in your view?
I believe we are all trying to achieve the same outcome through different means. I mentioned earlier how the board should be doing value-focused activities, and if the board does not do it, then market discipline should kick in to push the board to do it. What some markets have done is to put direct pressure on the board, direct pressure to disclose value-focused plans. These seem to have worked, but then their market conditions may be very different. For example, their markets may be enjoying a tailwind because of the difference in strength of the currency. The important thing is that we need to do what is right for our market at this point in time, and what we are doing is more indirect by enhancing the effectiveness of the board so that they are more ready to do value-focused activities and encouraging market discipline to push the board if they don't. But, maybe Ben, I ask you as an observer, what are your views?
I'm not generally a fan of cumbersome rules and regulations, but I do think there is a case for more prescriptive rules when it is clear that there's a misalignment of interest between controlling shareholders and minority investors. When a controlling shareholder decides that it makes more sense to take his company private instead of trying to enhance its trading liquidity and market value, then minority investors need the protection of more prescriptive rules, in my view. In those instances, rules such as requiring exit offers to be both fair and reasonable and requiring independent directors to appoint an independent financial advisor have not really afforded minority investors the protection they need. Many companies own assets that have private market valuations that are plainly visible to public investors, such as real estate, or stakes in other public listed companies, or even cash. Indeed, many investors choose to own shares in such companies in anticipation of this value being unlocked one day. So in take-private deals, I think regulators ought to be able to direct boards to take the private market value of those assets into account. The key is whether there's a misalignment of interest between controlling shareholders and minority investors. But it seems to me, Boon Gin, that you are also leaning towards more prescriptive rules. You mentioned earlier that SGX RegCo has hard-coded the 9-year term limit for directors and CEO pay disclosure in its rules. And that was because companies have been dragging their feet on these matters for years. Are more prescriptive rules an inevitable element of SGX RegCo's value-focused approach?
Ben, the reality is we cannot legislate for every outcome. I wish that we could, but we can't. That is why, with something like diversity, it is so difficult to prescribe because there is no single magic formula for ultimate success. So what is good for one company may not be good for another. So a lot of these things we simply cannot legislate for. The nominating committee of the company is in the best position to decide what the ideal composition of the board is. What we can do is to focus their attention on the right things so that they have in mind the right considerations. Ultimately, what we have is a disclosure-based regime. There must be a role for the board. There must be a role for market discipline. The consultation we launched on 23rd April on enabling shareholders to convene meetings is just one of the initiatives that will encourage greater market discipline. And greater market discipline is one of the 3 areas of work under our value-focused approach. We are working on other measures and intend to unveil them progressively over the coming months. We look forward to working closely with the rest of the market and receiving your feedback and ideas as we refine and roll out the measures.
Well, we're all certainly looking forward to that. That's it for this episode of Mark to Market. Thanks very much to SGX RegCo CEO Tan Boon Gin for joining me today. I'm senior correspondent Ben Paul at The Business Times.
This is a podcast by The Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts.